now we are going to a panel and seminar. The discussion A2 is capital market and the RMB and the long-term financial liberalization. Everybody knows is in China, the capital market actually is developed in a relatively short time compared to the Western society. And I would like to say it's a very success. And of course, they start from is the period is everybody is possible is no knowledge what is a capital market, what is a stock market. Actually, is everybody try to buy stock, try to get rich overnight. And until now, is people is more reasonably understand what is the role of the market. So therefore, this panel is we will invite some very important and distinguished guests to give us the opinion or comments on today's Chinese capital market. And the first is Professor and Dr. Jian Wulin from Tsinghua University. And another panelist is Sheng and Veneroso. And Veneroso is very knowledgeable and more productive and financial, I want to say is financial creator. And because his policy is now widely is used by the World Bank and another international financial institution. The last the guest is Mr. Sheng. And I think everybody already know him. And he has a very high profile both in Hong Kong and mainland China in terms of financial service regulatory and the leadership. So, you know, this is the China panel is we are basically focused on the financial market. And we're going to do this way. In the morning, we already have a very wonderful panel. This afternoon, and I believe is you will get more interested and more information from a panelist. And we do this way, and I will ask the panelists to give us a brief speech, and that is within 10 to 15 minutes. And then I will give the right to the audience to ask more questions, more interaction. And so we change this a little bit. So how about we start from Veneroso? Give an applause for Veneroso. Yeah.
Hi, I prepared a 25-minute speech that...
no, you can go to 25.
I can't fit into 25 minutes. Listen, I thank you for the opportunity to be here. And I have thought about what other people have said, and I'm dropping some of what I was preparing to say to try and respond to what they were saying. I want to think about the Chinese problem from its origins in China. I've had a long experience in the developing economies with policy, and to me, China is completely and totally different. I go back to Zhou Enlai's 4 modernizations: industry, agriculture, national defense, science and technology. When Deng came back from his exile in a machine shop somewhere in the provinces and started to run the country, he picked up on the 4 modernizations. And for him, it was a hybrid private-public model with strong party leadership and a command economy backing. China had a per capita income that was at the level of the countries of the Sahel. And Zhou Enlai said that our objective was to be able to catch up to the advanced economies from that level in 30 years. Just an unimaginable idea. That was not a development objective that was a dynastic objective. And I believe that the whole explanation of what has happened in China has to do with this dynastic effort for China to regain its former millennial status as the leader of the world. So the West is very critical of the command side of China's economy, and I see it as having made it possible. A market would have never done anything like this. Growing the capital stock at 10% a year for a third of a century, unheard of, and efficiently. The TFP, the total factor productivity during the miracle, was beyond anything any other economy, including here in Southeast Asia, has had. I believe that to understand this, you have to go to the pioneers of economic development. China did exactly what Arthur Lewis said, and even more so what Paul Rosenstein-Rodan said. Paul said, there are a whole bunch of things that you have to do in the big push, because the market will fail to do them: human capital development, social overhead, complementarity of industries. And that's what planning did in China. And that's what made it all possible. Now people are telling you to liberalize, to go to a market regime. And what I'm going to tell you is that China has two extremes, two disequilibria the world has never seen. One is a real sector disequilibria called a growth disequilibria, and the other is a financial disequilibria. It's the outcome of the miracle. It is the most extreme in history, and it puts China on a tightrope. It puts it on a knife edge. And it's very, very easy for this economy to topple on either side into something like an abyss you are not thinking about. And if you went to a market regime, the market would push you off of it. So I'm here to tell you why you should not liberalize, and why you should stick to your roots and understand where the miracle came from, how these imbalances resulted, how they came about, and what your perils are and what your policies must be. Okay. In economic growth, it's really all about capital accumulation, or economic growth per head, and productivity gains. In the developed world, there's a certain level of capital to output and a certain investment ratio. Now, you could add to growth by adding capital per unit of labor. But we never do it in the first world, never for 150 years in US history, because as soon as we do it, the marginal product of capital falls, and the financial return to capital falls even faster. And that brings it back down again. The developing economy is totally different. It starts with very shallow capital and very, very inefficient, outdated capital. You have on the shelf all of these machines that the world has developed over 100 years, and you can pick them off and put them into place. And instead of having diminishing returns, you will have increasing returns. And that's how you can have capital deepening. That's how you can grow your capital stock at warp speed, and with high efficiency and with high profitability and high self-finance. That's the magic of development. You did it, a few countries have done it, almost all countries. They have not converged on the first world, at least after an initial spurt. It's really amazing how rare the miracle of China is. But now there's a problem. Now you're growing your capital stock at the rate you did, in fact, a little faster, more than 10%. But for an economy that is in the path of development, and you're converging on the status of the advanced countries, there is a concave curvature to your arc. You wind up having exploited the easy and efficient things, and it gets harder and harder, and so your total factor productivity comes down. The speed limit on your economy comes down, and in China, you've also lost labor force growth. So you have a speed limit that was 10% when the capital stock was growing 10%. You were in sync. And now the capital stock is growing at 11%, and the speed limit on your economy is 7 or 6. That means you're proliferating capital you can't use in a way that was not the case 6 years ago. In a private economy, that excess of capital would have brought down returns, and the investment ratio would have fallen a long time ago. But you're not a private economy. You're a command economy with totally different behaviors. And so as a result, the capital stock keeps growing rapidly. You're proliferating unutilized capital. Financial returns are falling. So how do you finance that capital, that investment? You have to do it now more and more with debt. Debt dependency has taken off. That's why the debt to GDP ratio has gone so rapidly, up by 17 percentage points a year over the last 14 and a half years. When for all the profligate nations that went into financial crisis, it only grew at a 10 percentage point per annum rate. So you have this growth disequilibria, but it spawns a financial disequilibria. It spawns the proliferation of debt. Now, in that situation, you're on a knife edge. If you were to bring down the investment ratio, you could close the gap. But the problem is that when your investment ratio is 49%, and it should be in sync with demand at a level of rate of 15%, you're talking about an enormous investment decline. This would generate accelerator multiplier dynamics, and you would have a massive hard landing. On the other hand, if you tried to bring it down gradually, you would still have too much proliferation of capital. You would still have debt dependence. You would still be issuing debt. Your indebtedness would still be rising very rapidly. On the other side of your bank balance sheet, money would be exploding. You already have a money to GDP ratio of 200%. It's one of the highest in the world. These are the dynamics of financial crisis down the road and the dynamics of a monetary-driven high recursive inflation. That's the other side of your knife edge. Somehow or other, you have to find a way. You're a tightrope walker over a great chasm. You have to get to the other side, and when that's the case, the only thing that matters is getting to the other side. All other policy priorities are lesser. What would liberalization do? First of all, you should devalue, not revalue the exchange rate, because that will give you higher profits in the tradable sector and less debt dependence, and less of a chance that the private tradable sector will start an investment downturn. You should not take profits out of the SOE system, because that, once again, will increase debt dependence and imperil, at least in some places, investment, even though it would be nice to transfer resources for the social safety net. You must not raise interest rates, because if you raise interest rates, you will reduce the self-finance of all of the borrowers. That will do the same thing. That will increase debt issuance, that will increase the rate of debt expansion, and that will imperil investment. All these things will push you to one side or other of this perilous knife edge that you have to walk. There's another issue. As part of this dynastic objective, there is a social compact in China. If I play my part in making a contribution to the growth of the capital stock at warp speed, government will support me in various ways. And that has been going on for 30 years. You have an assumption of a government bailout that is so replete in this economy, it is like no other economy in the world. You have moral hazard that is mega. Also, because you have had 10% growth and high profit rates, you have entrepreneurial expectations that are euphoric beyond imagining. These are not the behaviors of people in market economies. If you were to instill pure market forces, and you shocked these expectations, you would wind up with all these agents doing what Hyminski called make position. They would start to liquidate. Your banks would do the same, but you won't allow them because you control them, thank God. There is a last problem, and that is when you have this kind of moral hazard, when you have this kind of assumption of a government support, what happens is that people who borrow and people who lend agree when debt service comes due, and there are problems to basically refinance, including capitalizing the interest rate. Capitalizing the interest rate is called Ponzi finance. Ponzi finance is standard practice in China, all across China for decades. People think that's bad, that somehow that's causing your debt growth and your financial crisis, but that's wrong. Because Ponzi finance, capitalizing interest, only raises debt when the real interest rate is high. But I have seen economies where the real interest rate has been high, where Ponzi finance has gone systemic, and the real high interest rate has compounded the debt. This is an economy with a behavior, a Ponzi behavior, pervasive and deeply rooted. And if you have flexible interest rates and high interest rates, you will start not financing expenditures, but just financing the real interest rates due in a way that will explode your debt further. So my view is there are a lot of policy priorities down the road. Yes, maybe down the road we have to have higher interest rates to have more efficient allocation, and maybe we have to, surely we have to provide resources for a social safety net. But right now, given these two world record-breaking disequilibria, real and financial, you have to be very careful. You got here with planning. You can only get across the high wire with planning to terra firma. Do not rely on the market. Thank you.
It's a wonderful speech, and it's frank. Actually, it's a talk about it's a lot about liberalization, and talk about the constraint. Talk about especially talk about the growth equilibria and the investment equilibria. How you solve these two equilibria together. And I think that it gave a very insight and comments on how we view today Chinese economic development and the capital market. And include the last point that you point out is the real interest rate. How you see the nominal interest rate, the real interest rate in China. So therefore that is very, very sharp point in these fields. And then next, I would like invited as Mr. Sheng Liantao and give us a speech.
Thank you. Thank you very much. I was going to, debate whether I was going to use Chinese, but since everybody's using English, I'm going to use English because I've got a fairly complex paper to present. Now, first of all, I want to really thank my very good friend, Rob Johnson. Oh, that's not mine. Something's wrong. Can you put it back? Anyway, I just want to thank Rob Johnson for this wonderful partnership. And of course also the Tsinghua HSBC Business School, under Ying Kong and all our leadership here. As you know, I'm an adjunct professor at Tsinghua School of Management, and I'm very close to Tsinghua. Tsinghua is very close to my heart. Last year we were here, the Fung Global Institute in May. We brought one Nobel laureate, Mike Spence, and one Lord, Nick Stern, This year, INET has brought one Nobel laureate, Bob Engel, and one Lord Adair Turner. So we're going to repeat this next year with 2 Nobel laureates, right, Rob? Anyway, I just really want to, really great to have all these great names here, Anatole Kaletsky, Brian Arthur, and Bill Janway. And I particularly want to thank Vice Mayor Tang Jie, and Director Tao, and Madam Zhou, and all these experts talk about these very issues. Now, I have known Frank Veneroso since the 1980s. I've known how passionate he is, how strongly he feels about this issue. And of course, he wrote the book not just about the crisis of the 80s, but also about the 90s, the Asian crisis. So what I really want to do is to use complexity economics to explain Frank's views. And I'm a little bit ashamed because Brian Arthur is the expert here, in this area. Now, what's the real issue? This crisis was created by too much consumption financed by too much leverage, and we didn't see it because it was a nexus between banks and shadow banks. Lord Adair Turner, talked about this. The response was QE, and plus macro-prudential measures, which is not yet complete, and today the emerging markets are in huge dilemma. Roughly 200 billion came in, maybe 1.2 trillion, depending on the numbers you want to see, and then some of that money is going out. And so we're really facing a systemic crisis. This is not a crisis of one country. This is not a crisis of even a group of countries. This is global crisis. It's a system as a whole. And the only way we can understand this is not through neoclassical, but through complex adaptive systems and large feedbacks. Now, I'm not going to go into the difference between neoclassical and complexity, but yesterday's discussion about philosophy was that neoclassical was all about perfection. It's about going back to equilibrium. Whereas the real truth is, exactly like Wen Jiabao said, China is imbalanced, uncoordinated, unsustainable. It's not just China. The whole world is imbalanced. We're really in a non-equilibrium situation. And it moved from non-equilibria to non-equilibria, and through the phase of crisis. So we cannot go from mechanical when we're into relativity. Crisis is not exogenous, it's come from outside shocks. Crisis is within the system itself. It's not linear, but it's huge nonlinear feedback. It's not partial, it is interconnected, interdependent, and that's what we change. And this chart is about the complexity economics, which I highly recommend you to read Brian Arthur's article on complexity economics. Now, the reason why we got into trouble is classical economics, which we use to frame capital markets, which is this talk is all about, is really about the functions. Sorry, I beg your pardon. I didn't. I beg your pardon. It's about resource allocation, it's about price discovery, it's about risk management, it's about corporate governance. And I used to teach this, and I was wrong, because resource allocation is totally distorted, exactly as Frank says. Price discovery is totally distorted when the interest rate is 0. Risk management was a total failure, and corporate governance, as we know, is also a failure. The whole philosophy didn't stop this crisis. And a lot of this happened because of globalization and regulatory tax arbitrage. So we're facing a massive paradigm shift. Systemic risk is endogenous in the system, and Keynes' disciple Minsky is absolutely right. Stability creates instability. Now, what's the modern financial system? It went from maturity mismatch, credit transformation, maturity transformation, to liquidity transformation. Liquidity transformation by the private sector is cooking up money, waiting for the central banks to bail them out, right? And so we really get into a problem in which the financial sector is not serving the real sector, right? And China is now facing, as Frank says, this financial disequilibrium, but we need a methodology, a theory to get us out of this. And we need to get out of short-termism. We need to have an understanding it's not about debt, it's about capital. It's not about leverage. You can't solve a debt problem by printing more debt and more money. You have to solve the capital base. So how we do this is a critical issue. So, you know, we traditionally looked at the world from a top-down basis. But the whole building up modern finance theory missed out history. You know, Citibank was not created overnight. Goldman Sachs was not created overnight. There is 100, 200 years of history before we got there. But in the last 20, 30 years, the World Bank will come in and say, you build a stock exchange, you solve a lot of your capital market problems. Wrong. We completely ignored the grassroots capital, which today PEs, VCs, angel are trying to find out and trying to resolve. And the real issue is about the marginal efficiency of capital. This chart, which I recommend you to study, you know, this chart is Minsky's definition of how investment drives profits. And that is the China model. You invest, you will get profits. But you over-invest, and you will have losses. And that's where we are now faced with this impossible dilemma. Because China is now facing two complex feedback mechanisms. There is a feedback mechanism domestically, and there's a feedback mechanism externally. You know, so when somebody says you must raise interest rate, or as Frank says, you must not keep the interest rate up, you can't. Because if you try to raise interest rates and global interest rates are low, there's a limit in which you can raise it. That's the feedback mechanism that we're dealing with. And I'm using Lord Adair Stern's favorite chart. It goes to show how everything is connected to everything else. It's this feedback mechanism between money, asset prices, the real economy, and global situation. And how did we get there? We got there because we made the world financial innovation faster, larger, more complex. And that's exactly the evolution of entropy, the evolution of a complex adaptive system. And today, it's unsustainable because the money is flushing around in capital flows of roughly 1.5 trillion, and maybe, you know, some of it has actually flown out of the system since last year. Now, what are the lessons from the United States? The lessons of the United States is that bubbles are associated with very low real interest rates. The lessons from Japan is that when you keep interest rates very low, it doesn't lift the economy, right? And so what is the key role? Now, I've talked about the capital markets. What is the key role of the renminbi? Well, the main purpose of the renminbi going out is to support real sector growth. If the Chinese economy is now one of the largest trading economies in the world, it's quite natural that the renminbi should play a role. You know, not necessarily to challenge, not to challenge the dollar, but to support, you know, the renminbi. Sorry, I don't know why it won't move. I beg your pardon. Yeah, you know, the previous chart basically said that China is counterparty to half of Asian cross-border trade, but 9% of the trade is settled in renminbi. And the most recent paper by the IMF basically says that if you liberalize, this is a simulation, more money will go out and also more money will come in. Basically, China's integration with the rest of the world economy will continue. Now, the reason for this is quite obvious. There is an official rate and there's a shadow rate. And if the shadow rate is larger than the official rate, are you surprised there is a lot of arbitrage going on in the system, and the regulatory arbitrage and the foreign exchange arbitrage? So the People's Bank has difficulty managing this exercise because capital flows, even if there's exchange control, is a factor in the domestic liquidity situation. Now, I want to say this very clearly. Shadow banking is actually a clarity of property rights issue. The real issue is not about the shadow banking liability. The real issue is where is the asset? And how good is the asset? And legally, who bears the risk? If you buy a wealth management product, is it the individual? Is it the banks? Is it the government? So, you know, if it is moral hazard, how do you handle this issue is clearly a major problem. So we really now need to look at the system as a whole, not just the real sector, not just the financial sector, but together, and how does this interact internally and with the rest of the world. This is an extremely complex issue for which current financial discipline, financial theory, and a lot of the real theory doesn't answer very well. We need a very different way to think about this. And if you want to think systemically, you need to think it at 4 levels. The level of macro, the level of mezzo, which is the institutional link between the macro and the micro, and then also the meta. To give you an illustration about the meta. The meta is really the difference between neoclassical and complex adaptive systems or complexity economics. As a regulator, I used to think if Bank A is fine, Bank B is fine, the system is fine. Wrong. Actually, what it is that Bank A and Bank B are transacting with each other, derivatives, toxic assets, good assets, bad assets, and if we stop, which is exactly what happened, all the balls fall down and we're all dead. So what has happened? Since we're throwing bits and pieces around, the central banks are saying, if you stop throwing, I need to pump more money to get you to keep on going. And we're now exactly in that dynamic stage, whether the whole system is either imploding or it can be kept still through QE. It's a really difficult issue. So to sum up, and I want to leave some time for discussion, we really need to understand that we cannot solve this in silos. We used to say if the central bank was specializing in monetary policy, regulators specialize in regulation, the system will be solved. We only recognize the fact the whole system is uncoordinated. Not coordinated at the national level, not coordinated at the global level. So we really need to understand that Asia is emerging, China is emerging in a very complex global system. What will emerge is not going to be a Chinese system, it's not going to be a Western system, it will be a global system, a global theory. We need to work together at this. We have not even got anywhere near it, but you cannot have a system in which nobody pays tax. So that's why I recommend you have a Tobin tax, you have the Tobin tax, you have to deleverage the carry trade, you have to have better understanding of how everything is interrelated, and we will have to do this exactly the Chinese way by crossing the river, by feeding the stones. Thank you very much indeed.
Thank you for Mr. Sheng give us this speech. And basically what I understand Mr. Sheng actually is give the society a formula. Is a financial society a formula is this system is a systematically crisis. It's not one part. Not if we look at it as the shadow bank, we look at it as another part that is not the problem come from a small area. So this is the whole system. So if it's a Chinese, the market system go forward, and we need to solve this problem, and we need to look at those problems as in the whole picture, rather than just we see, we have the shadow bank, so then we have to solve the shadow bank. We have to give the regulation for the shadow bank. That is what I understand as Mr. Sheng, the key point. And the next panelist will be a professor and a doctor, Jianhu Lin, and from Tsinghua University.
Okay, I want to take this chance, really thank you for everyone. I think actually Andrew thank you actually to the speakers. I'd like to thank for all the staffs, right? So basically 2 months ago, we actually started talking about the idea to put this meeting together. And really there's a lot of hard work from Tsinghua and INET, but also from our organizer, GTA and the EXR. So they really like the people working in the background, make this one happen. So we want to actually stand proud to all the staff in the meeting, right? So basically, I think really, really interesting. I think a lot of people talking about interest rate liberalization, and the first 2 speakers also talking about the stuff. So actually, I want to talk about the capital market philosophy behind the T-bond trading and the treasury bond view. So like everyone know, so that's actually very interesting in China. So after 18 years, we start to trading that one in the last Friday. So basically, we get this one back. And the major purpose of the T-bond trading is really give like the first step for the interest rate liberalization. So a lot of people are talking about, I remember the Professor Gang Xiao was actually talking about really we have very low interest rate, the real one should be going up. So let's see actually what's market actually react to this one. So this is actually the screen actually show on here. So talking about the T-bond trading in the first day. And I just checked my message for the second day. So the T-bond trading was keep going down. So if the people have the knowledge know like when the T-bond trading goes down, so futures going down, so means that the real interest rate should go up. So like market actually confirm the idea that's really in the market we need a really higher interest rate to really actually compensate stuff. And I want to actually send another thing. Probably you see this big screen, right? So this is actually a huge meeting setting up in the international finance company actually in Shanghai. And that's also set up by the same organizer actually over GTA group. So basically we actually trade as the same as the national event before. So that's really proud about this one. So basically, I will probably give a brief introduction about the T-bond, and then talking about the three philosophy. So as the Professor Kong say, I will probably skip a lot of things, just probably put the idea in front of you, and then later on I was really work on actually a lot of questions and a discussion later on from the speakers and also from the audience. So we can all talking about the things because we not only want to present the problem, we want to actually solve the problem. So I think probably the T-bond trading is one of actually the solution. Right now, the central government from China is really actually proposed to solve a lot of problems. One of the problems actually we're facing right now. So basically the T-bond futures is part of the financial futures. Sorry about actually the Chinese characters, since I was actually have this PPT before actually with the international future company before, but then I was not really consistent, but I like to share this one. So basically they have the index futures and the interest rate futures and actually the foreign exchange futures. So basically, the T-bond future is really part of interest rate futures. So why I want to present this one is really I want to present the idea about the first things, the pricing philosophy behind it. So we're talking about risk, a lot of things. So really actually, when we're actually talking about risk, pricing, and market, the problem, the first thing we have to ask ourselves is, do we really know what kind of risk we're facing? And is the price underpriced and overpriced, right? So if we don't have idea, is that true or not, then how we actually can solve the problem? So if you're looking at the current actually financial market, I think it's really like the mathematical formula. So if you need to actually calculate all the pricing, you need really the complete formula to calculate it. So you need plus, minus, and multiply, division, and then later on the square and the integral. So you need a lot of things. But first of all, you need really the plus. What is plus? You long the stock, you long the instrument. And what's the minus? It's a short, right? So you really actually going to borrow stock, do the stock loan, and short the interest, futures, all the things. And then we're talking about multiply and the division. That's a leverage we do, right? So in China, they start to actually have the short ability, but it's still limited. But we're actually going to have more complete formula in this one. So then we actually kind of start to work on the square and the integral. That's actually our derivative, the options, right? So we kind of have the complete formula for this one. But then let's see actually, is there enough parameter we should put in the formula to calculate the price? So we basically have the fundamental information. So that's when we have a lot of analysts we have a good system to really actually abstract information from the fundamental information to really actually give the investor good hint. But we also have the supply demand. Basically, we have the stock market and the future market. But do we really know what is actually interest rate level right now we should facing? No, we don't have idea before. Do we know actually what kind of credit risk we're facing? No, we don't have the idea. So then later on, the volatility and the foreign exchange risk, we have no idea. So basically, why I was so excited about the T-bond trading resume is really actually they at least give us part of the answer for the interest rate and the credit. So that's two like important parameters we should inject to the system. So that's actually really like the idea. So basically, so for the T-bond trading, we actually set the base interest rate system, and we also actually help that one for the bond market, because you know, like in China, it's totally imbalanced. Right now, the stock market is much bigger than the bond market, but in US, it's reverse. China was actually start with the stock market, but really like in the most of financial system, it start with the bond market. So right now, this one is really helping that one to really regain the balance. And the third one is really actually give us the way to control the interest rate like volatility. So that's actually, I just briefly talking about the first philosophy. We really need to know what the pricing is. And then there's another thing is really, if we want to know the pricing, we really need to build a market, right? We need to trade. We need to trade to really know the idea, because regardless actually how good actually formula you build, when your prediction, that's not really will be to get very close to really the real price. You need majority vote for this one. So we need really a mature market to help this one. But how we really build a mature like the financial market? So I like to use like a very typical like a formula in the active portfolio management. So people are talking about actually the alpha relate to the Sharpe ratio, volatility, investment breadth. So basically there's a formula talking about, so really actually if you want to get actually exceed actually return basically alpha, you need three things. IC, information ratio, stand for information ratio, and actually sigma like stand for the volatility, and the square root of n is really stand for the investment breadth. So basically, they basically tell you three things. If you want to make money, you actually need to really a good skill to really predict, and then very transparent information. And second thing, you need actually very good and fair volatility. So good opportunity to do and the stuff. Because in the English, they tell about like the time makes a hero, right? So hero actually do nothing but actually produce actually by the time. So third thing is really the high investment breadth. So you need more instrument, you need to create it. So, but that's actually what investors want, and what's the skill for the investor. But what is really the market should do? So market should do, the first thing, a good regulation. So good regulation give a good, fair IC, because information transparent, that one fair to everyone, so people can make the good judgment instead of really controlled by the certain like manipulative people. And the second thing is the good and the fair volatility, means actually you really need to do the antitrust, you need to do more participant in the market. And you have the volatility, but you want the good volatility. And third thing is really the high investment breadth, means you have to create like more like instrument and with very low correlation. So if you have all the things for the market when you're building, then you actually have this one. So, but in China, like when they first like building the T-bond market, they didn't do that. They have only one product, the liquidity is poorly, and really the information is not really transparency. So that's actually costing on the like 1995, the market total crash. But after several years, so actually the liquidity was going up, and also there's a lot of regulation actually putting around here. So basically helping really the market do. Another very good thing is really actually the T-bond itself provide a lot of liquidity for the market, for the chains. So that's actually why like right now they offer the T-bond bill again. And also, let's look at actually in the international market. So that's actually a list of like all kind of T-bond futures offered in the 20 country and the 27 future exchange. And that's actually, so you can see actually T-bond future was coming from the Western area right now into actually the Asia area. So like see, actually the first actually one was offered in the US, actually in the Chicago, the CME. And the major thing actually CME did for the T-bond is they provide very good liquidity, but they are very, very creative. So basically what happened is, so during actually last actually 20, 30 years, they create tons of different T-bond and also the derivative around it. So basically provide a lot of actually different diversification for the market. And also they provide like a very good like liquidity and also the pricing mechanism for this one. Another thing is actually the self-regulation. In the US, they actually allow people to regulate themselves and also through like a 3 different structure from the government, from the association, and from the investor itself. So another good example is really actually in the German. So German actually provide very good liquidity for their trading. That's why they're successful, and also good regulation. And the same as English, in the British, so I don't really want to repeat. One thing I want to mention is in the Australia. So in the Australia, you know, actually, in the 1997, there was actually not really actually they really want to actually offer like a lot of a T-bond to the one because their actually several dice was actually not really that high. But they actually offer that one to the market mandatorily. So what that want to do is really they want to push in the liquidity to the market so to keep the pricing mechanism on the market. So, but there's a lot of a good example, but there's a lot of bad example. So basically one thing I was talking about is actually in the Indian market. So Indian market was actually manipulated, actually kind of have a huge manipulation on the market. So like all the position was held by only actually the brokers, not the banks. There's no market maker, so actually causing a lot of problem. And the same actually on the Taiwan. So that's actually a very interesting picture. So this is a picture happened on the 1988. So in the Taiwan's Congress. So they're talking about actually the tax policy for the T-bond. And one was a congressman was jumping on the table to really fight with the chairman. So that's actually one problem because Taiwan, they want to put down the tax for the hedging property. So really make the T-bond have no way to serve as the hedging properties. So, and another thing is in the Taiwan, there's also a kind of antitrust problem. So most of the T-bond was holding by only actually several government like owned actually companies. So I think I was pretty much actually going to end, but one thing I want to actually surround it. So one thing I want to people think about it is for the T-bond market. So normally people, a lot of Asian people, a lot of Asia future market people doing the arbitrage. So you know actually the Taiwan market and the Korean market, that's actually, it's most like a speculating market. So like the turnover on the market is very high. So is that really actually we need? We need some speculator on the one, but we also need a long-term investor on the one. So people have to be educated to do that. So there's all different strategy we do, but actually, you know, like in US, there's a new pioneer way to do. Like, I'm not really going to go to detail, but there's people use that one to building like SPV and also offer that one as actually inflation protection using the T-bond. So that's actually probably one example we should learn in China to actually educate the people to doing more and more things on this way. So that's actually solving the problem. A lot of people talking about actually the bank problem. So actually the T-bond solving one of the problem for the Lehman Brothers, because T-bond really actually the cap bond actually offered in the US, they didn't default except actually the Lehman Brothers, because actually the Lehman Brothers are holding actually the total risk swap in there. So right now they replaced by the T-bond, actually they offer the stuff. So I would say like if a financial instrument, they want to do the things, they're not only suitable for the arbitrator, but they also should be suitable for the long-term investment. So I just end with my speech right now. Thank you.
Thank you for Professor Lin, and give us a very special example of financial market T-bond. And Professor Lin introduced this special market in China, and also introduced the management aspect of this financial market, like self-regulation from American. And also give us the two examples, Australia and India. And that is very helpful for the audience to understand is the innovation of China financial market. And the next section, we will give the audience to ask a question. Before audience ask question, I want to have some view, want to discuss with Mr. Sheng, Lin, and Frank. And actually, in the morning, I tried to ask this question from Dr. Song Min's session. Is everybody know in China now is we call online finance. It's developed very fast, like from Alibaba, right? And also other organization, they all develop is another system, and beyond the bank now, and also beyond and the financial company, is purely is like is one company create online this borrow and debt. Okay, as I said that. So I want to ask is Mr. Sheng, is because you talk about the shadow bank, and also in the morning talk about is a lot of the regulation about the shadow bank. So however, in our society, so far, every day we create kind of shadow bank. And what I know is kind of government allowed to do it. At least so far, government haven't interfere this area. So from your point of view, so this is supposed is financial innovation in China, or this is possible create another problem? Like in the future, is we possible have the regulation problem come again? That's right. And we haven't solving a central bank, the shadow banking now, and then we create another one. So how you think about this?
Well, you know, if you are traditionally trained, you would argue that some things must be regulated.
Must be there, okay.
But if you are looking at it from a Chinese philosophy, yin yang 哲学, you know, you realize for every yang there must be yin. If for every regulator there must be an unregulated entity, right? Yeah. So whatever you try to regulate, things will move to the unregulated. That is the nature of life.
Okay.
Right?
Yeah.
So the issue is that if you recognize that the system as a whole is always evolving, every time you regulate something, something unregulated will pop up. Right? And so, you know, that's exactly what we're seeing. Now, why is there online trading? Why is there, you know, virtual finance? The answer is if you regulate this part and I move into cyberspace where there's no regulation, I'm a winner. Right? So, you know, you need to recognize that this is the evolution of a system itself. And if you have used the traditional thinking, you are thinking every time there's an effect, there's a cause. So if I sort out the cause, the effect will be dealt with. Complexity economics actually recognizes a cause is an effect and an effect is a cause at the same time. They interact with each other with basically what Soros calls reflexivity, the feedback mechanism, right? And then you really need to treat the system as a whole rather than 脚痛医脚, 头痛医头, which is exactly what we're always doing at the same time. Because we're not looking it as a system as a whole.
Of course, yeah.
Right?
How you see the future of this area, like the online financing?
The future is inevitable. The world is getting networked through new technology.
Okay.
Right? Let me give you an illustration. The best example is this. 72% of the people in Pakistan have mobile phones. 10% have bank accounts. Who is going to be the big winner in finance?
It's very
It's
good
obvious,
example.
right?
Very
It's very
good,
obvious, right?
Very good example.
Right?
Yeah.
So the question then is, do you stop the people using mobile phones to have every mobile phone holder must be regulated?
Okay.
You know, this trend is inevitable. The only question is, how does regulation move in such a way that the whole system benefits?
Yes. Yes.
That's the heart of the issue.
Yeah. Yes. It's a Frank. Do you have any?
Well, I don't know anything about the details of this. All I can tell you is that I've been around longer than all you guys. And I know that the record of financial liberalization and emerging economies is horrific. There was a liberalization in Latin America at the end of the 70s where I was a policy advisor, and it resulted in the first truly deadly debt explosion in the Horn of Latin America. And not only did we have a huge financial crisis, but we had depression-type declines in GDP. The third world debt crisis was basically a financial liberalization. We basically turned the financing of emerging markets over to the banking market. And the go-go bankers went and buried everyone in their damn debt. And if they had not been bailed out, they would have all died. And there were episodes along the way. I knew some of these guys, Pedro Aspe under Salinas in Mexico, Domingo Cavallo in Argentina. Liberalization, the results were terrible. And the worst of all was the East Bloc with the end of the Soviet Union. Big bang liberalization. And I mean, you had all the extreme disasters you could possibly have. So when I look at China, and you did so fabulously as a hybrid economy, and the Zhou Enlais and the Deng Xiaopings wouldn't allow everything that the market would want to happen. They wanted to make sure that it was all in a controlled way to a dynastic end. And I view all this shadow banking system and all of these free capital markets with flexible interest rates, given this psychology, given this behavior that has come out of these 30 years of success, as being very, very fertile ground for markets generating all these terrible excesses that we know all about. As someone said earlier today when they asked a question, they said, I went to New York and they said to me, why do you want capital markets? They're bad.
Yeah, it's a Professor Lin. Yeah.
Okay, I think this is a fantastic question. I was actually asked myself actually a lot about these questions. So it's really actually the shadow banking is right or wrong. My personal view is it's not really right or wrong. Just this one just a tool, right? So the bank cannot really hold risk. You have to send to somewhere else to digest risk. There's a demand for this one. I totally agree. Actually, Ms. Andrew and Frank say. And really, actually, the question is how we really realize the risk inside it. Because I was actually talking before, we really need market, we need actually the exchange to really actually trade the product like efficiently, so we realize the risk. Most likely, the risk is not really dangerous. It's really the problem is you don't really know how many risks you have. So I'll give you an example. I work in the government from during actually the crisis, you know, like Lehman Brothers crisis, right? So after that one, like I read a lot of book actually in Chinese, they're talking about, so Goldman Sachs is really like empire, like a vampire empire, like they really actually just actually make money, they do a lot of inside trading, all the stuff. It's not true. So I tell you what happened. It's really like when the Lehman Brothers crisis, like I'm actually working as the quant strategist. So entire firm, like all the quant strategists was called back from everywhere else. We was locking in actually several floors of room, and we actually calculate counterparty risk. So we have very powerful system. We realize actually what kind of risk we expose. And then we start to put in the hedge. We liquidate the positions, we put in the hedge, all the stuff. So, but the rest of people, they don't really know. So Bank of America, Citibank, all the stuff, take them actually a month to realize the stuff, right? So same risk. We're facing the same risk as them, but we realize that one. So we actually solve the problem, and they don't really know. So if you actually go online, there's a funny story. So you probably know there's a very big hurricane happened actually in the last year called Sandy, and there was actually hitting actually the lower Manhattan. And the picture, I didn't bring the picture, but if you see, like entire lower Manhattan is dark, except Goldman Sachs 200 West. So what happened is, like they're looking at in front of Goldman Sachs, it's really like the defense area. So they have all the sandbox there, around there, and they have their own power generator. But if you look at like a couple blocks there, the Citibank, there's only probably less than 10 sandbags in front of the door. So I think really we do is we should, when we're actually facing the shadow bank, we should really do the same thing as the Goldman Sachs or other smart actually investor. We should know what kind of a risk we have, then we actually can solve the problem. If we have no idea, regardless how we're talking about stuff, we cannot solve it. So that's my idea.
Thank you. Well, wonderful answer. And I would like to give the floor to the audience. So therefore, because we try to squeeze more time to give the audience to ask a question. Okay, is there anyone? So, okay, that lady is please walk over. Yeah. And can you introduce yourself first a little bit?
Yeah, thank you for giving me the chance to ask questions. This is Christina from the Asset magazine in Hong Kong. Talking about capital market, I think in the past months, the two events I'm quite interested in. One is the T-bond, the other is the Everbright Securities incident. And I know Mr. Lin is an expert in quantitative trading. So probably the question can be best answered by you. I want to hear your comments on this event and what the regulators, market institutions, and maybe exchange can take from this event. And is it likely that the exchange will have a unified warning system to regulate the high-frequency trading? And maybe briefly, if you can, have a brief introduction of the quantitative trading on the markets in China.
Okay,
Thank you.
There's several questions, yeah. So probably let me answer one by one, all the fantastic questions. So talking about actually, you're probably talking about the interest rate crisis that happened, like the small crisis happened there? Or you're talking about the fat finger one for the Guangda?
Yeah, it's Guangda. It's,
okay. So there's like different ones stuff. So the Guangda one, I think that's actually the system problem. So basically, what happened is, based on my understanding, that could be actually, there's a formal one actually happened. It's really the Guangda, they do like the cash interest rate, like basically called the index futures arbitrage. So they basically buy in actually the cash product and then sell short for the index. But actually they have like probably around like a 700 million renminbi position. But actually what happened, they end up with, they finish their trading about the index futures, but actually when they try to buy the cash to balance out, their system have the problem. They send in the order, they already basically complete actually on the market, but the system didn't communicate back to the main strategy box. So then they actually started doing the stuff, end up with actually around like 7 billion renminbi position, and then they start to use their own position like ETF or other things actually short. So that's what I learned from the staff. Could be wrong, but that's my side of information. So that's actually really, we have to think about actually high frequency trading. I don't think that's really the problem for the high frequency trading itself. It's really we need to really have put more infrastructure for the actually the system. We need a good, really accurate data. We need actually really a good actually system to give us the feedback to conduct stuff. Because right now, in the world is really like a connect to each other very fast, because the high frequency trading, because I always tell people the funny story, like 2 years ago, I went to New York, there's a high frequency trading meeting, and what happened is I went there, there's no really anything related to the high frequency trading. It's really just a lot of like a computer, and with actually the pump, like a hydrogen pump inside, and I would say like, what happened? So this is called like a water cooling system, and they cool really the CPU temperature. So if you keep the temperature 1 degree low, then you actually can have your trade send out 1 millisecond faster, and that means actually millions of dollars for certain things. So you see the system right now, after we introduced the high-frequency trading, basically the world was connect like very fast. It's really like a chaos system. Really, you know, like one butterfly was actually shake there, like the wind actually in the Amazon. Then there's the hurricane in China. So that's what happened, right? So then we have to really actually invest the good things. And talking about actually the quantitative trading in China, this is booming right now because I was always talking to people, there's really a huge chance actually in China to do actually the quantitative trading. Most actually, it's good for the market to realize actually all kind of like a pricing issue and good for the investor to make money here. Because if you look at market correlation right now in the US, it's kind of like 70% right now between the stock. But in the US, in the China, it's only like 40%. But the chance is very low. The chance is very high, but the time period is very low. Because right now, I think why we actually have such low correlation, because we still can fully short stuff, and there's very little actually instrument that we can trade, like to short market. But actually after that one come in, then I think the opportunity will come very quickly. So give you example, like if you look back actually the US market, it took like 10 years for them to really actually shrink the spread from the cash product and the index futures to around like a 10% level from the 50% level. But right now in China, like since like 2010 and April 16th, then start trade index futures, the spread shrink very, very fast. And actually take only 3 months. And another thing is for the T-bond futures, basically I talked with the serial trader actually yesterday and today, and they tell me the market is very, very efficient. So most of the people, they already know the pricing, so everyone goes short. They know like stuff. They don't really actually arbitrage. Usually basically the individual investor usually go the other side, so basically the arbitrator can make money. Right now it's very, very hard for them. So they have to be the one side actually direction instead of really doing the arbitrage. So I think we're getting a good opportunity. People have to move very fast in the Chinese market to really get it.
Okay, thank you. What is the next question? Is there any question? Any audience want to ask a question in terms? Okay, let the gentleman, and please come over.
Hi, I have a question for Mr. Andrew Sheng. So talking about financial liberalization, I think partially, I think shadow banking is a consequences of both financial repression and financial liberalization, in my personal view, because we see the bank's wealth management products growing very fastly and trust company products growing very fastly, but actually banks are only allowed to do wealth management products and after 2004, and trust company and the bank trust corporation thing only happened after 2007. And we saw the security companies allowed to do semi-trust business since October last year. So there is seems to be a short history that the Chinese regulators are liberalizing these financial markets to promote for certain purposes, but there seems to be a lot of unintended consequences as the shadow banking sector is growing extremely fast right now, and people view it as a very risky business. So what do you think about this financial liberalization in the future? I mean, given that we're talking about asset securitization thing, but given all the unintended consequences caused from the previous financial liberalization, do you think we should be more cautious in the future? Thank you.
Well, I think, as I said, this shadow banking, has it served a real sector function? The answer is, if somebody is willing to pay a window interest rate of 15%, which is higher than the official interest rate, why is that? Right? We need to understand that. And secondly, is it sustainable? What does that tell you? Just because there is an effect doesn't mean that just stopping the effect will solve the problem, because it's all interconnected, right? A lot of this issue is about if you regulate one area but you don't regulate the other, the problems will pop up in the unregulated area. That's essentially the market beginning to work, right? So one needs to diagnose this, and one needs to have a process of understanding it rather than to react immediately, right? This is bad, this is good, right? Take, for example, fast trading. Just give you an illustration, right? If we allow only a few companies to do fast trading, which is today accounts for 60% of the turnover in the advanced markets, there'll be no retail left, because all the retails will be eaten up by these fast traders, especially those guys who can pay the exchange to give them 0.123 nanoseconds faster than everybody else. This is not fast trading, this is market manipulation, okay? So one needs to be very clear. Not everything is good, not everything is bad. You need to weigh up very carefully what the implications are, what the spillovers are. We have now begun to see, which we didn't see before. We used to assume that externality was almost zero. That was the old assumption. Today, spillover is huge, right? Your problem is my problem is your problem. We're all interconnected, and there's a lot of feedback intermechanism. So we need a little bit more humility to accept that you cannot regulate everything, you cannot control everything. The market has a certain self-order. You need to set the conditions for the market to work what it is good at, and the regulator and the government needs to know it needs to do what the government is good at. Okay? So, these are the issues that we need to appreciate. The market is very good at product innovation. The state is not very good at product innovation, right? But the state is very efficient at institutional innovation. It can set up new institutions to react to what happens in the market, right? If it needs a certain amount of regulation, let the government do it, because the private sector won't be able to do this. So I think we need to be a little bit more humble. We must not expect instant solutions. This is the problem with neoclassical. For every problem, there is a unique first best solution. This is rubbish. This is absolute rubbish, because we all know that for every solution, there are even more problems. Every solution you create has more problems, right? So life is actually a continuous evolution between cause and effect. The feedback mechanism needs to be understood. And that's why the Chinese reform is not a big bang. It's actually a gradual sort of search, discovery, experimentation. Make wrong, move backwards. Move right, expand, right? So, and when you expand, you're bound to make some mistakes. It's inevitable. The fact that the whole world is moved towards, technology of some kind, financial innovation, sometimes cannot be stopped, because they're all moving that direction. But, let me give you a simple illustration, right? You say, oh, you're using models. Actually, if I have a super model to model what the market is modeled, actually all I did was not calculating what the market is. I'm replicating what that model is behaving. Because if everybody starts using that model, the market begins to change by itself, right? So you need to appreciate some of these complexities in the system. And that's why it's very Sheng. It's mysterious, but it's like organic issues. We cannot think that for every simple issue that comes, we have a simple solution. And we can't turn back the clock, because we're keeping always evolving in this area. So there's no simple answer to this, but it's a philosophy. You need to appreciate that if these things are happening, you need to move with the times, but you need to learn how to read it, and so that you can actually minimize some of these externality problems that you have.
Thank you. And we take as one more question, and anyone want to ask some questions? So I think today is a very special moment, and we have real experts from a financial market, and I do encourage the students and the young scholar, you can ask a question, because take this advantage. And anyone have questions? And this afternoon is because everybody is a little bit tired. Okay.
I would like to make a comment about what Andrew just said.
Okay.
I'm very sympathetic to this idea of gradual policy change and probing. It sounds like that statement of Deng Xiaoping that policymaking was like feeling one's way through the stones in a running stream. But it seems to me, and I'll go back to this point, I don't think it's sinking in. China has a growth disequilibrium the likes of which the world has never seen. It has an investment ratio that is higher than anyone has ever seen. So it could be on the edge of an accelerator, multiplier, investment-led break like Asia has never seen, and you don't have time to feel your way across the stones in the running stream. And at the same time, if you really are growing indebtedness at 17 percentage points a year, then you're moving very, very rapidly towards a threshold from which, for any economy that went beyond that threshold, there was no return without a financial crisis. And so there is an imminent peril. And I don't think people are aware of it.
Could I just respond to this? I think you know, the reason why I'm beginning to use Chinese philosophy or complexity economics to think about this issue because of interrelationship. You know, when you have a cause and effect, you have a fashion. Everything overshoots. We all know markets overshoots, policies overshoot. And once you use the word overshoot, it's actually value loaded. You assume that there's an equilibrium, but there is no equilibrium, right? China's disequilibrium is changing global disequilibrium, which is then feedback into the Chinese disequilibrium. Now, when you talk about debt, this is the real problem. Everybody talks about the debt, but what happened to the asset? The real issue is not about the size of the debt. The real issue is about the quality of the asset. Mm-hmm. So when we talk about the local governments, oh, your debt is unsustainable. What happened to the asset? They invested in assets, and they have a lot of assets. Why don't we look at properly the balance sheet, and the returns, whether they have social return or they have negative, private returns, right? So we need to understand this much better, and I think, the Chinese authorities are moving in that direction. We can't expect it to solve this overnight, but I think that's the area where we need to move so that we understand it's not either market or the state, but it is both. That is both the liability side, the asset side that you need to look at. And if the asset quality is okay, then like Japan, for example, you look at the gross liability, but they have a lot of assets. So how can you use that asset to reduce the debt? Maybe the solution, rather than saying, well, you must keep the interest rate very low in order to maintain that sustainable debt.
Yeah. So any other questions? And okay, if you do not have other question, and I would like to closing this session, and I want to make the final comments of this session. And actually, it's just like Frank said, look at China. Right? It's developed and very fast. Within 30 years, 40 years, we build up. Now, as we call it, a market financial system. And then look at this system as the whole picture. And of course, we see some problem, we see achievement. Right? Like as Andrew pointed out, it's no any system is perfect. So therefore, we look at both sides of the system, and the positive side and the negative side. Always think about externality. I'm an economist. I really like this word. So you do anything, and you think about that the externality would happen. Sometimes it's positive, sometimes it's negative. That's right. So therefore, I think that is the key point from this session. And I would like as audience join me together and give a big applause to the panelists. Thank you. Thank you. Okay. Finish. I think this panel is finished. Great. We'll go to another.